Welcome to Wall Street Niger LVG. I go by the name of Mashola Bemigo Ofuya, the macro translator, as you already know. And you're welcome to another Forex market breakdown and analysis. In the Forex market sentiment still remains cautious. We don't have a strong risk on market yet. Why? Because everything's hanging on the deal between the US and Iran. As of this moment, the deal has not been concluded between the US and Iran. So until that happens, oil prices may likely buy into the gaps in the market, and we may see investors stay more cautious and a bit risk averse. Last week, Friday, we had the NFP for the USD, the average hourly earnings, and then we also had unemployment rates. Total unemployment rates declined. We saw a series of unemployment claims reflect in the unemployment rates, which is a good thing for the labor market, showing that stability, workers not being unemployed for longer periods of time. And then we saw a huge decline in the total number of jobs being created in the NFP, which showed slowing in job creation in the US economy. And then average hourly earnings ticked slightly lower, showing that workers didn't demand more wages in the previous month. That could also feed or tie into core inflation. Those three macro indicators, a leading the lagging indicator, shows that the Federal Reserve may be tilting towards an easing cycle. So the window for a rate hike seems to be closing in. It's going to be interesting to see how CPI for this week reflects. I do think CPI may not be higher than market forecast, even though inflation expectations still remain elevated. The overall picture that we've seen for the past couple of weeks and months shows that there is a cooling in headline inflation and also core inflation. So that may tie into the Federal Reserve decision going into the rest half of the year. So they may likely keep interest rates unchanged to see how headline inflation holds. What's going to happen between the US and Iran? That's going to be important for the Federal Reserve. And also Friday, for the Canadian dollar, we had employment change and unemployment rate, which was impressive. Unemployment rates pretty much declined consecutively. And then employment change, about 75K jobs were created by the private sector and the public sector, even though the reports show that public sector jobs declined slightly and most of the jobs were created by the private sector. This shows that the Canadian economy is in an expansion in H2. So we may see a stronger Canadian dollar. Why? Because the Bank of Canada is likely to keep interest rates unchanged pending when that demand in the economy picks up. Because don't forget, the series of rate cuts that the Canadian central banks embarked on is starting to reflect in the economy, because we can see that in the labor market. Until we see demand inflation outside headline inflation, the Bank of Canada is likely not to raise interest rates. And also this week we have the AUD monetary policy meeting, where the RBA is going to tell us where they are with interest rates, although market forecast shows that interest rates remain unchanged. We're going to unpack that Tuesday. And also we have GDP month to month. We're going to know how the UK economy has grown, or if it's slowed in the previous month compared to the month before. And then we have the USD core PPI, core retail sales and retail sales, and we have consumer sentiment and inflation expectations. So we're going to see how all of this unfolds. But the takeaway is we actually see a weaker US dollar going into the week. And Bank of Canada, a series of rate cuts are showing improvements in the economy, improving businesses, improving demand for labor. It's going to be interesting to see how this week unfolds. It's a very interesting week in the market, because central banks' decisions now hang on how the deal between the US and Iran unfolds. Stay logged to the macro translator so I keep you informed and updated as we go along this week. I wish you a wonderful week, a productive week if possible, lots of profit. Have a wonderful day and cheers.